Why are risk-adjusted returns crucial for investing? Have you ever wondered why some investments seem to shine while others fade away? The answer often lies in understanding risk-adjusted returns. So, why are risk-adjusted returns so important for investing? Let's break it down. Risk-adjusted returns measure how much profit an investment generates compared to the risk taken to achieve that profit. This is essential because it helps investors see not just how much money they made, but whether that return was worth the risk involved. Simply looking at raw returns can be misleading. Higher returns usually come with higher risks. Risk-adjusted returns give a clearer view of an investment's true performance by balancing both aspects. For adults planning their investments, considering risk-adjusted returns is vital for several reasons. First, they allow for fair comparisons. Different investments carry different levels of risk. By using risk-adjusted returns, investors can compare investments on an equal basis. For instance, a stock that returns 10% but has high volatility may be less appealing than a bond returning 7% with much lower risk. Next, understanding risk-adjusted returns aids in better decision-making. It helps investors choose investments that match their risk tolerance and financial goals. This understanding prevents overexposure to high-risk investments that might offer high returns but also come with a significant chance of loss. When it comes to portfolio management, risk-adjusted returns play a key role. They assist in balancing assets to optimize returns for the level of risk an investor is willing to accept. This leads to more stable and consistent growth over time, which is what many investors aim for. Another important aspect is identifying true performance. Some investments may look great based on raw returns but might be taking on excessive risk. Risk-adjusted measures reveal whether the returns adequately compensate for the risk, helping investors avoid choices that are risky without enough reward. Common ways to measure risk-adjusted returns include the Sharpe Ratio, which measures excess return per unit of total risk. The Sortino Ratio focuses on downside risk, measuring return relative to negative volatility. The Treynor Ratio measures return relative to systematic market risk, which is useful for understanding performance compared to overall market movements. For adult investors, using risk-adjusted return metrics is practical. It helps in selecting mutual funds, stocks, bonds, or real estate investments that fit their risk profile and financial plans. This approach supports making informed choices that balance potential gains with the likelihood of losses, leading to more sustainable investment outcomes. In summary, risk-adjusted returns provide a more complete and realistic assessment of investment performance. This is vital for effective portfolio building and management. By focusing on risk-adjusted returns, investors can align their decisions with their personal risk tolerance and financial objectives.